Hello, everyone. My name is Roomy Acosta. I am Head of Investor Relations of JOST Werke SE. And today I want to give you a quick overview about our results for the year 2024 and what's coming ahead for us in 2025. So 2024 was a year that for JOST was actually a very active year from a strategic point of view. We announced biggest acquisition we've done in the history so far, which is a company called Huba that has been consolidated into our group as of the 1st of February of 2025. But the market themselves last year did not support the business development. We had both declines in transport and in agriculture, up to even 20% in some markets, 27%, for instance, in the US for trailers. And it was overall given the cycle, a very, let's say, moderate market environment to act. But we could show our flexibility and our resilience in the business, although given our high market shares worldwide, we did have to, of course, our sales themselves also went down with the market. For instance, in transport by 19%, in agriculture organically by roughly 12%. We did have a positive contribution for two M&As that we did in the year 2023 that were for the first time in 24 consolidated for 12 months instead of 4 months like in the year 23. So that here we saw actually on a reported level a growth in sales in the agricultural business line. But despite these declines organically, we managed to keep our adjusted EBITDA margin stable at 13.9% compared to prior year. We achieved a record free cash flow of 150 million euros and decreased our leverage to 0.86 times EBITDA, despite the decline in overall EBITDA that we saw. Reported net income grew by 1% to 53 million euros, given a very good financial result. And adjusted for a one-off effect that we had in the financial results, which was positive, adjusted EPS decline roughly in line with sales, a bit less than sales by 16% to 5.20 euros. And we are proposing to the annual general meeting stable dividend compared to prior year of 1.50 euros per share. So when we look at the group, and I already talked a bit about this, we see here how the development was regarding the business lines. So 19% decline in transport, 5% decline, increase in agriculture, but actually organically only a 12% decline. And the margins were, I already mentioned it, 13.9% adjusted EBIT margin stable. On EBIT level, the margins declined to 10.6%. compared to prior year, given the fact that depreciation and amortization did not decline in line with sales, but still a very good result given how low the overall demand for transport goods was in the industry last year. So very good cost control pair with active portfolio management that helped to offset the decline in top line and good development in the material and freight costs, plus, of course, the very resilient aftermarket helping us to maintain the high profitability that JOST has had over the past years. If we look at the regions, we see actually here that North America was, as I mentioned before, one of the markets hit the hardest because of the trailer development in that market that went down by 27%. Also, trucks started to decline in the second half of the year, and agriculture never quite recovered despite that. And you see here, the margins remain quite stable, even though we took a hit of 27% on the top line at 11.3%, very good development. In Europe was where we consolidated a portion of vast majority of the M&A acquisitions that we had. That's why the difference between reported and organic is a bit higher. But also here, despite everything, the decline in profitability was in line, given the fact that actually the markets dropped organically by 18% overall. And Europe, bear in mind, has the highest proportion of fixed costs because a lot of R&D costs as well as central functions are allocated to European region. Asia Pacific, Africa also declined, not as much as North America and Europe, but a lot of the market recovery that was expected for India never materialized after the elections and has been actually postponed for 2025. according to expectations. So there too, given the weakness in India and the fact that the China domestic economy never quite recovered, sales also declined slightly. Despite that, it was less dramatic than, for instance, in North America and Europe, because the Southern Hemisphere, especially Brazil and South Africa, the Pacific region, did quite well. And we also profited from the very strong export business from China into the Southern Hemisphere that supported our sales also in that region. Very good profitability with 20.4% adjusted EBIT margin. Still not continues to be a very good region for JOST, given the high share of off-highway mining equipment that we have in that region. In a nutshell, we actually kept our outlook that we gave in the year 2024 with sales decline of 14% compared to the 15% we had announced, a double-digit decline in adjusted EBIT, and the adjusted EBIT margin was in the corridor of 10.5 to 11% we have given. Only in CapEx we were slightly above. That has to do that despite the decline in sales that we had, we continue to invest in efficiency measures, automation, and a certain and all types of. We consolidated 2 plants, one in China and one in the US, in order to generate efficiencies for the future. So we did not change our CapEx plan, and given the low top line, the percentage of CapEx compared to sales increases slightly to 3.1%. So overall, a very good year despite the markets not being supportive, showing the resilience of the business and the strength of our local for local strategy. So looking at 2025, what are we expecting right now? So this picture numbers are from March, so it does not include whatever impact the tariff discussions might have on the economy. As you saw here already, North America was expected to be quite weaker this year than Europe and Asia Pacific, Africa. And these numbers that we see here is a bit of a bottoming out of the cycle with a slight recovery already. Is something that we are starting to see also in the order intake at the beginning of the years, both in Europe as well as in Asia Pacific, Africa. The impact of the tariff is very difficult to judge right now, like on a macroeconomic point of view. JOST has a very local for local approach. So we produce for the US market, and a lot of our suppliers are also either in Brazil or close or even in the US, so that the direct impact from the tariff is not that big. However, we will have to see what happens to the overall economy as such. But given these market's expectations and what we are seeing so far, and taking especially into account the consolidation of the Hyva Group the 1st of February of this year, we are expecting a growth overall for the group in sales of 50 to 60% of sales compared to prior year. Adjusted EBIT will grow by 25 to 30%. This has to do with the fact that Hyva, and this was communicated when we announced the deal, is slightly dilutive compared to the JOST business, but we have a very clear synergy plan for the next 2 years that will raise them up to the JOST level in the first 24 months after consolidation. So here too, we are very optimistic. And yeah, adjusted EBITDA developing in line with EBIT, CapEx around 2.9% of sales, and working capital will probably increase slightly compared to very, very good last year, given the fact that we spare a bit of more activity levels on the market, as well as the fact that Hyva has a slightly more working capital than JOST, requires a bit more working capital than JOST does. So overall, despite everything, we're very concentrated in the integration and consolidation of Hyva, see a lot of growth opportunities through combining both groups to grow further into the future, and are looking forward to what's ahead of us. If you have any more questions or want to know more about JOST and our business strategy, you can always find out more on our webpage under Investor Relations, or you can reach directly to me. Thank you very much for your attention. Have a nice day.
Disclaimer. As described in the legal section on our website, c11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seed11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.